Volta's year-to-date performance of 6.44% in NAV terms reflects the broader rebound in the credit markets following the downturn towards the end of 2018. More recently, however, Volta has posted a 1% negative total return in June, which was partially the result of the depreciation of the US dollar versus the euro, but also the reduced interest of investors in floating rate debt instruments. This includes CLO tranches as well. This is a result of the recently changed rhetoric of the Federal Reserve and ECB, signaling a more accommodative monetary policy as a result of subdued economic growth prospects, as well as more limited inflationary pressures. When we examine Volta's performance, we need to distinguish between the impact of mark-to-market of asset prices and Volta's ability to generate continued strong cash flow from their underlying loan pools. These cash flows improved visibly in comparison to last year, and as at the end of June 2019 stood at 19.2 million euros on a 6-month rolling basis, translating into a solid dividend cover of around 1.7 times and a 13.3% yield on closing NAV. These improved cash flows are largely a function of higher coupons received both on CLO debt and equity tranches. These cash flows should improve further as the company expects to receive first payments from 2 CLO equity tranches acquired earlier this year. We acknowledge that the prospective rate cuts may reduce coupon payments on floating rate loans, which represent the majority of CLO collateral. Having said that, we also note that the credit spreads are still slightly ahead of last year, while default rates remain at a very low level, which should support cash flows from the underlying loan pools. This should be further assisted by the expected monetary easing. Having said that, we still believe that we are in a late cycle environment coupled with an increase in covenant-light loans, which means that the ability to select the right CLO managers still represents an important factor determining long-term returns. Volta has been able to consistently implement its strategy of locking in cheap cost of funding by acquiring new longer-dated equity tranches, with the 2017 to 2019 vintages now representing the majority of CLO positions. As at the end of June 2019, Volta's portfolio was mostly composed of CLO positions, which represented 82% of the gross asset value, including 44% in CLO equity tranches. It has also taken advantage of the lower prices of existing CLO equity tranches amid the downturn we've seen towards the end of 2018. As a result, the company was able to source new investments with an expected IRR between 11 to 13% and is now fully invested.